the world's greatest investor, a man worth over 100 billion, a man who has spent his entire life studying markets, reading financial reports, and picking stocks better than almost anyone who ever lived. Do you know what he told ordinary people to do with their money? Not pick stocks, not hire expensive fund manager, not try to beat the market. He said, put it in an index fund. Leave it alone, go and live your life. His name is Warren Buffett. And if the greatest investor in the world is telling you to keep it simple, maybe it is worth exactly to understand what he means. This is what today's video is all about. Index funds. What they are, how they work, why some of the smart money on the planet swear by them, and why they might just be one of the most important things you ever learned about money. Let's get into it. Before we go any further, I have to be upfront with you. I'm not a financial advisor. Nothing in this video is financial advice. This is purely educational. Every financial decision you make should be made with a qualified professional who understands your personal situation. We are here to learn together. This is it. Now, let's go. Now, let me paint you a picture. Imagine you sit down, you decide you are going to pick the best stocks. You do your research, you read the news, you watch the markets, you feel confident. And maybe, for a while, you do well. But here is the uncomfortable truth that the financial world does not always shout from the rooftops. Study after study has shown that the vast majority of professional fund managers, people who do this full-time with huge teams, with access to information most of us will never see, fail to consistently beat the market over the long run. Not some of them, most of them. So if the professionals with all their resources, all their experience, all their tools cannot beat the market year after year, what chance do the rest of us have trying to do it in our spare time? This is exactly the problem that index funds were built to solve. So stop trying to beat the market, just be the market. Okay, so what exactly is an index fund? Let's start with what an index is. An index is just a list, a snapshot of a group of companies or assets that represents a part of the market. The most famous one is the S&P 500. That is a list of the 500 largest companies in the United States. Apple, Microsoft, Amazon, Google, Johnson & Johnson, 500 the biggest businesses in the world, all in one list. When people say the market went up today, they usually mean the S&P 500 went up. Now, an index fund is simply a fund that tries to copy that list exactly. It buys a little bit of every single company in the index. In the same proportion, no guessing, no picking winners, not trying to be clever. If Apple is 7% of the S&P 500, the index fund holds 7% of Apple. If a small company is 0.1% of the index, the fund holds 0.1% of that company. It just mirrors the market perfectly automatically. Thinking of it like a mirror in a hall of mirrors. Whatever the market does, the index fund reflects it straight back. If the market goes up 10%, your index fund goes up roughly 10%. If the market drops 8%, your fund drops roughly 8%. No surprises, no secrets, just the market as it is. And here is why that simple idea is so powerful. Over the long history of the markets, they have gone up. Not every year, not in a straight line, but over decades, the general direction of them have been upwards. By simply owning the whole market, you capture that long-term growth, without having to guess which company will win. Now, you might be thinking, surely paying someone smart to manage my money is better than just copying an index. It feels logical, it feels like you are getting something more. But here is where the numbers tell a different story. Actively managed funds, where a team of Excel experts pick stocks on your behalf, typically charge much higher fees. We are talking anywhere from 1% to 2% per year, sometimes even more. And as we talked about in our last video, fees compound just like returns do. Over 30 years, even a 1% annual fee can slightly cost you tens of thousands of euros. Index funds, because they are not paying a team of stock pickers, charge a fraction of that, often as little as 0.03 to 0.20% per year. So lower cost and historically better results for most investors over the long run. Now, that doesn't mean that actively managed funds are useless. No, there are exceptional fund managers out there, but finding them in advance before they have their good years is incredibly difficult. Index funds remove that guessing game entirely. You are not betting on one manager being smarter than anyone else. You are betting on the long-term growth of the economies. And historically, that has been a much safer bet. I want to tell you about a bet. In 2007, Warren Buffett made $1 million wager. He bet that a simple S&P 500 index fund, something anyone could buy, would outperform a collection of hand-picked hedge funds over the next 10 years. Hedge funds are the elite of the financial world, run by some of the smartest, most experienced investors on the planet, charging enormous fees using complex strategies most of us will never understand. One side of the bet, the fancy professionals, other side, the humble index fund. 10 years later, in 2017, the results came in. The index fund returned around 85% over the decade. The average of the hedge funds around 22%. The simple, boring, do-nothing index fund won by massive gain. And it was not a fluke. This was the most famous investor in the world deliberately providing a point that the most ordinary people, simple beats complicated, boring beats exciting, and patience beats cleverness. Almost every single time. So far, so good. But now you might wondering, okay, how does someone actually get started with this? Let me break it down simply. And remember, this is educational, not advice. Always speak to a professional about your specific situation. So, first, you need a brokerage account. That is simply an account that allows you to buy and sell investments. There are many platforms available. Some are designed specifically for beginners with low fees and simple interfaces. Second, you choose your index fund. The most common starting point for many people is a fund that tracks a broad market index, like the S&P 500 or global index that covers thousands of companies across multiple countries. Third, you buy just like buying anything online. You decide how much you want to invest and you make the purchase. And then, this is the hardest part of most people. You leave it alone. You leave it alone. You leave it alone. You do not check it every day. You do not panic when markets drop. You do not get excited and sad when markets rise. Simply let time and compounding do what they do. This is why people call it lazy way to build wealth. Now, if you watch our first video on ETFs, you might be sitting there thinking, wait, this sounds exactly like what we talked before. And you are right, they are very similar. But there is one key difference worth understanding. An index fund and an ETF can both trade the same index. They can both hold the same basket of companies. They can both have very low fees. The main difference is how you buy them. An ETF trades on a stock exchange throughout the day like a share. The price moves up and down in real time. You can buy at 10 a.m. in the morning and sell it at 3 p.m. in the afternoon if you want. A traditional index fund, sometimes called a mutual fund, is priced once at the end of each trading day. You buy or sell at a one daily price, no real-time trading. For long-term investors, this difference really matters. If you are putting money away for 20 or 30 years, whether you buy at 10 a.m. or end of the day makes very little difference. What matters far more is that you start and that you stay consistent. Here is something I want you to give in this video. The people who build real wealth with index funds are not usually the ones who invested a huge lump sum at exactly the right moment. There are the people who invested a little every month without fail for years. This is called pound cost averaging or euro cost averaging if you are in Europe. When markets are up, your regular investment buy fewer shares. When markets are down, the same amount you invest buys more shares at a lower price. Over time, this smooths out the ups and downs. It removes one of the biggest traps in investing, trying to time the market. Nobody knows when the market will go up or down, not the experts, not the analysts, not the billionaires. But do not need to know. You just need to show up every month consistently and let the market do what it has always done over the long run. Time in the market beats timing the market every single time. We live in a world that loves complexity. The financial industry especially has a habit of making things feel complicated because complicated feels impressive. Complicated justifies high fees. Complicated keeps people dependent on experts. But here is the simple truth. Some of the most powerful ideas in the finance are also the simplest. Buy a little bit of everything. Pay a little as possible in fees. Start as early as you can. Stay consistent. Leave it alone. This is the index fund philosophy. This is what Warren Buffett has been saying for decades. And that is what the evidence year after year continues to support. Now, does that mean index funds are perfect? No. Markets fall, sometimes badly, and investing always carries risk, which is why speaking to a professional who understands your situation is so important. But understanding this idea, truly understanding it, is one of the most valuable things you can do for your financial future, because nobody is coming to you and save you. No one is going to build your financial life for you, but you can build it for yourself on small informed decisions at a time. This is what this channel is here for. If this video added value to your life, share it, subscribe, and we'll see each other in the next one.